Implied volatility on S&P 500 options has been exceptionally low recently. But is that about to change? When one looks at the implied volatility on S&P 500 options and the slope of the yield curve side by side, there doesn't seem to be any obvious relationship. However, when one takes a 2-year moving average of the implied volatility and the yield curve shape, one finds a pattern that has been repeating for over 3 decades. For example, in the early 1990s, the US had a flat yield curve, reflecting tight monetary policy and high volatility in the equity market. This coincided with the 1990-91 recession. As a result of the downturn, the Fed lowered rates and the yield curve steepened. By 1994, the US had a steep yield curve and implied volatility had fallen to very low levels. So the Fed decided to raise rates, flattening the yield curve in 1994 and 95. Initially, the implied volatility didn't rise, but by 1997, it began an uptrend that culminated with the 2001 tech wreck recession. The Fed then again eased policy in 2001 and 2002, which steepened the yield curve and reduced implied volatility on equity options. By 2004, with a recovering economy, the Fed began to tighten again, which flattened the yield curve, and that ultimately resulted in a wave of volatility that accompanied the global financial crisis. The cycle repeated again between 2008 and 2020. Currently, the yield curve is steeply inverted. And if history is any guide, today's tight monetary policy might translate into a wave of volatility in coming years.